Gold traders, today we are not predicting price, we are reading intent on the gold futures H1 chart. First, always start with context. Gold had already completed a strong rally into the 43.80 to 43.90 zone. Momentum was high, but it was no longer accelerating. That tells us the rally was mature, not fresh. Now focus on momentum. At the top, money flow peaked before price peaked. Then came a decisive H1 candle. A bearish candle with a body of 1.42% and a wick of only 0.11%. This candle is critical because there was almost no rejection. Sellers controlled the entire hour. Before this drop, notice the green candle. High volume, highest money flow, right near resistance. This is not strength in gold, this is liquidity creation. Late buyers entered the breakout. Smart money sold gold futures into that demand. The next candle confirms it. Widespread down, strong volume, close near the low. This is a sign of weakness, not a normal pullback. After the drop, gold paused. Small candles, narrow spreads, volume falling, money flow stabilizing but not expanding. This is not accumulation. This is bearish digestion. Selling pressure paused, but buyers did not take control. Now place this into Elliott Wave logic on gold. The drop from 43.87 to around 42.87 was fast and impulsive. That qualifies as wave A or wave 1. The bounce that followed was slow and overlapping. Lower momentum, lower volume. That is corrective behavior. A B wave or wave 2. Now mark your gold levels. The high at 43.87 is your hard invalidation. Above that level, the bearish gold thesis fails. The zone between 43.36 and 43.50 is a failure zone for the bounce. And acceptance below 42.87 confirms the next downside leg in gold. So remember this, until gold reclaims the origin of selling, all upside remains corrected.